Daryl Liew. You're head of portfolio management at Reyl in Singapore. Now we've seen a kind of slowdown in the intensity of the American-Chinese trade dispute. The G20 brought about some relief in the whole process. Markets have been celebrating this in the yesterday and today, in the past 2 days. Are they right to do so?
Well, I think if you look at the situation, that the trade tensions have eased somewhat because, on the US side, it seems like there's a 90-day negotiation period where they will not be increasing the tariffs. So the extra 25% tariffs that we have hit on 1st of January has been pushed back. But there is still some concern in the marketplace that this is just kicking the can down the road, and that basically both the US and China are still pretty far apart in terms of fundamental issues. Because I think when you look at it, if it's simply trade related, then the US and China could have resolved this back in June already, where China had already agreed to import more US products. But if this is more strategic in nature, meaning to say that the US is still trying to curtail China's rise, then I think this is going to be still a long drawn process.
So you know the Asian side or the Chinese side, of course, quite well from the Singapore point of view. What lies ahead in a trade dispute?
Yeah, this is a good question, because I think, as I said, if it's strategic in nature, then basically the US and China probably won't come to any sort of resolution, because if it's the US objective to curtail China's rise, then China's not going to agree. This Made in China 2025 program, for example, is what China believes it needs to do to actually move up the value chain, to develop independence in terms of semiconductors, for example. This is not something that China is going to give up very easily. So I think if it's going to be on a competitiveness issue, then we're not going to get a resolution. Probably what the best case scenario there is that for both countries to come up with a framework in which to resolve disputes.
Now, the Western investors have become interested in the Chinese stock market, but this year we've seen quite a bad development. It's gone down. Is a trade dispute the obvious reason for that, or are there other factors?
Yeah, the trade dispute is one of several factors that have basically impacted China and the rest of Asian markets this year. You've had tighter liquidity as well as one of the key driving forces pushing the markets down, because the Fed has been hiking interest rates. You had higher oil prices in the first part of this year, which has also tightened liquidity. And then also one of the other concerns is that the US dollar has been strengthening, which tends to be negative for Asian markets. And then, of course, we have had growth coming out that has been a bit more disappointing. So all these are factors which have basically adversely impacted the Chinese market and other Asian markets.
What is your prospect for the Chinese stock market in the coming year?
Yeah, I think when we look at the outlook now moving into 2019, I think a number of the risk factors that have dragged the Chinese market down this year, we think that they're possibly showing signs of easing. Dollar strength, for example, dollar is showing some signs of topping out. And then you've got these trade issues which possibly might be resolved in some way or some form. And then growth figures, we're still quite comfortable with economic growth coming out from China, because our belief is that the Chinese government still has a lot of ammunition and dry powder to stimulate the economy if they need to. So we don't think that economic growth is going to be a big issue in China for 2019. They're still going to hit their 6 to 6.5% GDP growth target. So that should actually be supportive for the stock market.
Is there a stock market outside China that you find especially interesting or promising?
Yeah, there are some interesting Southeast Asian markets actually, because actually when you look at the trade issues that are impacting China right now, there has been some talk that some of the multinational companies that have been operating in China are looking at accelerating their move of their operations out from China into other countries like Vietnam or Thailand, for example. Note that this is not a new development. This is something that they've already been planning for for several years already. It's just that the trade issues in recent months have actually forced them to accelerate the move. So, for example, I've been hearing anecdotal evidence from Vietnamese fund managers that there's been more inquiries for operations in industrial parks in Vietnam, and also from talks that some of the Thai operations are picking up again because because of the strong Thai expertise in automobiles. So it's some industrial manufacturing might move to Thailand as well. So yeah, some countries in Southeast Asia could benefit if the trade issues persist.
Daryl Liew, thank you very much for your time.